Good day, everyone. Thank you for joining us once again here at Seafood and Brew for our briefing. And for this briefing, we're going to go over the first quarter performance of that community bank benchmark group. And as you might recall, that group is made up of banks with assets between $100 million and $5 billion. So let's look at the growth rates for the first quarter. Overall, when we look at the first quarter, we saw a growth rate of 1.22% for assets. That's up from the fourth quarter, so that's a single quarter's growth. That's a little lower from what we saw last quarter in the fourth quarter growth rate at 183. So overall, we saw that level of assets grow slightly slower. In terms of the overall loan growth, you can see we're up by 1.55%, higher than where we were last quarter on that gross loan growth of 0.82. However, when we look at net of PPP loans, as you recall, there continue to be loans that are being forgiven, so that weighs down on that on the overall loan growth. So excluding the PPP loan forgiveness, we can see we're at 240, similar to where we were last quarter at 2.42. So quarter over quarter, that overall level of growth in loans continues to be consistent. When we're looking at deposit growth, down slightly, down 2.24%. That's the growth rate from where we were last quarter, 2.28. So we've seen just a slight slowdown in that growth in deposits. Now, when we look more broadly in this deposits for all commercial banks, we can see over the last couple of months, it has been plateauing in here, even a little bit of a reversion. And this has been that question is, when will we see the tremendous amount of deposits that flooded the market? When will we see those move out of banks? And we're starting to see it plateau, that growth rate finalize here. I don't think we're at that point yet where we're going to start to see that come down. However, with the rate of inflation of where it is, we are starting to see people having to dip into their savings in order to maintain their spending habits. So will that have an impact? Maybe a little bit, but I think overall we're going to consistently see this flat level throughout the year. Looking at the performance side on return on average assets, we can see as an entire group, we moved down just 3 basis points from 0.93 to 0.90. So the group in its entirety moved down just slightly in the return on average assets. When we look at that group broken up into our 3 segments, if you recall, we look at the subchapter S institutions, stock institutions, and then that mutual group. We can see the subchapter S maintained their ROA at 1.10. The stock group came down by 4 basis points from 91 basis points down to 87 basis points. And then we had the mutual institutions dropping from 53 basis points down to 46 basis points. So we like to look at the ROAs, that performance for each of those subcategories. And when we do a reporting for our financial institutions, we make sure we line them up with the appropriate subcategory of that benchmark group. Now, looking at the what's behind ROA, net interest margin, we know we've seen a fairly consistent reduction in net interest margin over the past couple of years. And we see back in the third quarter of 2021, net interest margin of 334 dropping to 320 in the fourth quarter, And then in the first quarter, we get down to a 3.07. So we continue to see this move down or compression in that net interest margin. I think that's going to abide a little bit when we get into the second quarter numbers and then into the third quarter because of the tremendous increase in the interest rates. It's helping to push up that asset side of the balance sheet, those yields. Whereas on the liability side, with the flushness of the deposits, those non-maturity deposits, I think, are going to stay rather low. And we can see that in this component of net interest margin. We see the yield on earning assets continuing to come down due to the level of interest rates being subdued, as well as that change in the overall structure of the balance sheet, which we'll look at in just a minute. So we saw the yield on earning assets drop from a 345 in the fourth quarter down to a 331. So we had a pretty significant pullback in the yield on earning assets, whereas in the cost of funds, we moved down just 3 basis points from a 27 basis points down to 24 basis points. So we've seen that kind of floor out in here with the cost of funds. The big question is, when will we see that upward movement in this cost of funds? And that depends, of course, on the structure of your institution. If you have a lot of short-term borrowings, you're going to see that move up rather quickly. If you have a lot of non-maturity deposits, savings, money markets, nows, those are going to move up a lot slower. So over this course of the last 2 years, we've seen a lot of money move into the banks, into those non-maturity deposits. So that's going to keep this overall level of cost of funds down for at least the next 6 months. We might see a couple of basis points move up, but we're not. I don't see a real big uptick in the cost of funds throughout the next 2 quarters. When we're looking at the balance sheet, we have seen a little bit of a decline in those cash balances on the asset side. And we've known this has been a hampering impact on that yield on earning assets, with the level of cash is increasing from where it was back in 2018. Remember, it was 5.75%. Moving through the end of last year, got up to 11.32%, and then in the first quarter ending at that 10.61%, saw that reduction for the first time in 4 years. So we begin to see this move down. Overall securities also increased. We're at a 24.21 on the overall level of securities to assets. And this is growing from where it was back in 2018 at a little more than 19%. So we've seen this overall increase in the securities portfolio, which needed to happen because we didn't have the loans to put on the books. So this structural change inside the balance sheet has contributed to that reduction in the yield on earning assets. Overall, when we look at the net overhead, we're down here for the first quarter at 176, down from where we were last quarter at 184. Typically, we do see an increase in the fourth quarter in the net overhead because of bonuses that are happening in year-end expenses. So that's not unusual that we see that pick up. But even at that 184, we're still fairly low compared to where we have been in history. It used to be, you go back 5 years, that a 2%, anything less than a 2% was a fairly efficient institution, and below 175 was a very efficient institution. But because of the increase in the overall average assets that we've seen in the past 2 years, these levels have been pushed down. So we're now looking at, if you're below 150, that is considered a very efficient institution. At a 176, you're at average, up just 3 basis points from where we were most of last year. The components inside of the net overhead, if you recall, it's just the difference between non-interest expense and non-interest income. Non-interest expense continues to improve from where it was a year ago, going from 2.42 down to 2.33. Again, typically in the fourth quarter, we see an uptick in the non-interest expense. Non-interest income moved down to 47 basis points from where it was last year at 55 basis points, and the prior quarter at 52 basis points. There's a lot going on inside of these numbers. You know, the big worry about the NSF fees going away, that's contributing to a little bit of this falling down. We're seeing more and more banks get rid of that charge. But the one big move down in here was the fact that you didn't see as much of the gains from loan sales. So those gains of loan sales have come down, and that is expected when we start to see an increase in interest rates. We know that that market begins to slow down. So that was one of the big items that pushed down the overall level of non-interest income. Looking at that risk score that we give for our institutions, overall, when we're looking at the industry, we did see a little bit of an uptick in the risk and in the overall risk. And some of this, or most of it, primarily that increase was due to the increase in that capital risk. Capital risk has moved up because the overall level of rates moved up, and that weighed down the unrealized losses on those security portfolios, lowering the GAAP equity ratio. So that was one of the reasons we saw a little bit of a pickup in that capital risk. However, that being said, the credit risk continues to maintain at that lower level of moderate in here, and that's what the big worry is, that we start to see this credit risk become an issue, but that's not the case at this point. The risk that's increased in the capital is interest rate or market risk. Liquidity risk continues to be fairly low, and the earnings at risk continues at this elevated level because of the sensitivity in that net interest margin for the institutions over the past 2 years. That is the way that we look at that earnings at risk. And we do this for all institutions. So if you wanted to see where your levels lie inside of your bank for our risk score and our reward score, you can feel free to give us a call. But that's what we have for you today. The first quarter, a little lackluster in terms of growth, a little lackluster in terms of performance. And overall, I think we're setting ourselves up over the next year to hopefully start to see an increase in that net interest margin, led by these overall level of longer rates moving higher. And that should be a net benefit to our institutions. That's what we have for you today. We look forward to talking to you once again soon. Have a good day, everyone.